Welcome back to the deep dive. Today, I want to start with a scenario that I think is going to feel painfully familiar to a lot of you. It's that time of year.
Oh, yeah.
You walk out to the mailbox, you grab the mail, and you see that one envelope. You know the one?
Yeah.
From your home insurance carrier.
It's the envelope of dread.
Exactly. You take it inside, you put it on the kitchen counter, and you just stare at it for a minute.
Ah.
Because you know what's coming.
Are bracing yourself.
You are. You're thinking, okay, inflation is up. Maybe it's a 10% bump. I can handle 10%.
Yeah.
You rip it open, and your jaw just hits the floor. It hasn't gone up 10%.
It's doubled.
It's doubled. We are seeing average premiums in Colorado hitting $4,200, $5,200. And for a lot of people in the foothills, I mean, seeing a bill over $5,000 is becoming the norm.
It is staggering. And honestly, the first thing we have to do is just validate that feeling for people. You are not crazy. I was looking at data for just standard builds in Castle Rock, nothing fancy, and the premiums are crossing that $5,000 threshold.
That's a mortgage payment.
It is literally a mortgage payment for some people.
And the immediate reaction is, I need to shop around.
Right.
That's what we've always been taught.
You'll get any quote.
But that's the scary part of this 2026 market. You call 3 other carriers, and they're all within $50 of each other.
If you're lucky. Or worse, they run your address and just say, sorry.
Yeah, we're not writing new business in that zip code.
End of conversation. That's the reality check.
Yeah.
We have to reframe this. This isn't just inflation. We are witnessing a structural realignment of the housing market in Colorado.
Realignment, how so?
The insurers have crunched the numbers on hail, on wildfire, and they've decided the old pricing models were, well, they were basically charity.
So if you're trying to budget the old way, you're falling behind.
You're failing because premiums are rising way faster than inflation.
It feels like you're just bleeding cash. But, and this is where it gets really interesting, we've been digging through a massive stack of documents. We're talking IRS tax rules, specifically Publication 936. Yeah. New 2026 state legislation, and some pretty dense roofing standards. And we found a strategy. It's essentially a financial arbitrage play.
It is. It's a total shift in mindset. We have to stop looking at this as home repair.
Or maintenance.
Right. This is a wealth strategy. It's about leveraging the equity you already have to lower your monthly liabilities. It's a math hack, really.
So instead of just complaining about the bill, we're going to talk about using a HELOC, a home equity line of credit, to fund very specific home hardening upgrades.
And we should be clear, this is not for a new kitchen island.
No hot tub. We're talking pure ROI, shifting equity to lower a liability.
Exactly.
And before we get into the weeds, I want to mention a resource we're going to reference a lot today. It's the Colorado Equity to Premium Analyzer. At some point, you really have to plug your own zip code into this tool.
You have to, because the math works very differently in Grand Junction than it does in, say, Castle Rock. Geography dictates the risk, and the risk dictates the opportunity.
Okay, so our mission today, explain how IRS tax rules, this new House Bill 251182, and some cool roofing tech all converge to potentially make the insurance savings pay for the renovation itself.
Let's do it.
So let's start at the beginning. Why are the rates so high right now?
Well, you have the perfect storm, quite literally. You've got Hail Alley, the Denver Front Range, which sees some of the most destructive hail on the planet.
Right.
And then you have the WUI, the Wildland-Urban Interface. In 2026, insurers are just. They're tired of losing money on roofs. They see your house as a liability.
Okay, so that brings us to the solution. And we're not just talking about slapping on new shingles. We're talking about the IBHS Fortified Home 2025 standard.
Correct. And this is a really crucial distinction. This is not just a new roof. Fortified is a specific designation. It's a standard that goes way beyond normal building code.
Okay, so help me visualize this. What makes a roof fortified? Because to me, a roof is, wood and asphalt.
Think of your roof in layers. You have the shingles on top, that's the armor, but under that you have the wood deck. In a standard house, if a 90-mile-an-hour wind rips those shingles off,
which happens all the time here.
All the time. Water just pours in. It destroys the drywall, soaks the insulation. It ruins your life.
So the shingles are just the first line of defense. If they fail, the house fails.
Exactly. The fortified standard starts with what's called the sealed roof deck. It puts a waterproof barrier directly on the wood.
Okay.
It's like wearing a wetsuit under your winter coat. Even if the shingles gets ripped off, the house stays dry.
That makes perfect sense. It's a fail-safe.
It is. And then they require specific nailing patterns using ring shank nails.
Ring shank nails. What's different about that?
A normal nail is smooth. It can pull out pretty easily. A ring shank nail has these little ridges, almost like a screw. It has almost double the uplift resistance. It really bites into the wood.
And then there's the shingle itself. We keep hearing about Class 4.
The UL 2218 Class 4 impact resistant shingle, yeah, this is the gold standard. To get this rating, the shingle has to withstand a 2-inch steel ball
Steel ball.
dropped from 20 feet without cracking.
Wow. That sounds violent.
It is violent, but that's what mimics the kind of hail we see in Colorado Springs or Aurora. The goal here isn't just to stop leaks. It's to make your home undroppable.
Undroppable. I like that because that's the real fear, isn't it? It's not just the price. It's getting that non-renewal notice in the mail.
That's the one. We're seeing widespread non-renewals in the foothills. And if you get dropped, you might be forced onto the state's FAIR plan.
The insurer of last resort.
Right. It's expensive, and the coverage is, let's just say it's basic. The fortified designation is your ticket to staying in the private market with better rates.
Yeah.
You're signaling to the insurer that you are a safe bet.
Okay, so we know what we need. A Class 4 fortified roof, but now we have to pay for it. And this is where it gets real. We're talking $15,000, maybe $20,000.
Most people don't have that sitting in a checking account.
And even if you do, you don't really want to spend it on a roof. So this is where we pivot to the financial engine of this whole thing, the HELOC.
The home equity line of credit.
But wait, I can hear people yelling right now. You want me to take out a loan? Rates are around 7%. How does borrowing money at 7% make any sense?
It sounds totally counterintuitive, right? But you have to look at the net cost of that money. And this is where IRS Publication 936 saves the day.
Okay, let's unpack this. Because most people think that deduction for home equity interest is gone. I thought that died with the 2017 tax cuts.
That's a huge misconception. The deduction was eliminated for personal spending. So if you use your HELOC to buy a boat or pay off credit cards,
No deduction.
no deduction. But, and this is the key, the IRS left a very specific carve-out. Interest is still deductible if the funds are used to buy, build, or substantially improve the home that secures the loan.
Substantially improve. That is the magic phrase.
It is. The IRS defines that as something that adds value, prolongs the home's life, or adapts it to new uses. A Class 4 impact-resistant roof fits that definition perfectly.
Unlike, say, painting the living room.
Exactly. Painting is a repair. This is a capital improvement. So if you borrow against your equity for this specific type of roof, that interest becomes tax deductible up to the debt cap.
So the real cost of that money is actually lower. Uncle Sam is basically subsidizing the interest rate on your roof.
Precisely. You're using cheaper, tax-advantaged money.
Okay, so that's the cost side. Now let's flip to the other side of the ledger, the savings. Because for this arbitrage to work, the savings have to be big.
If we connect this to the bigger picture,
Yeah.
we have to look at the premium discounts. We pulled data on State Farm and other major carriers. Just a standard new roof can cut premiums 15 to 25%.
Just because it's new. But wait, there's more.
There is. If you add that Class 4 impact resistance rating, you can add another 10 to 15% on top of that. In hail-prone areas, we're seeing total discounts getting up to 35%.
35%. Okay, let's slow down and do the math. Let's create a scenario. Let's take John in Colorado Springs. Standard home, maybe worth $600,000. His premium just jumped to $4,600 a year.
Okay, so John's paying $4,600. If he installs a Class 4 fortified roof, gets a 30% discount, he saves roughly $1,380 a year.
$1,380 back in his pocket. Now, the loan, let's say the roof costs him $15,000, puts it on an HELOC at, say, 7.5%. What's his annual interest cost?
On $15,000 at 7.5%, the interest-only cost is about $1,125.
Wait a second. So the insurance savings are $1,380? The interest cost is $1,125.
Exactly. The savings cover the interest payments with a couple $100 left over. The insurance company is literally paying the interest on the loan you took out to upgrade your house.
That is the math hack. But we're missing a huge piece here, aren't we? The deductible.
Oh, the deductible is the hidden killer. This is where people really lose money. A lot of policies now, the wind and hail deductible is a percentage.
Right, it's not a flat $1,000 anymore.
No. We see 1%, even 2% deductibles. So back to John in Colorado Springs, $600,000 home, a 2% deductible.
That's $12,000.
$12,000. He has to write a check for $12,000 before insurance pays a dime.
That is insane.
It is. And here's the arbitrage. If you install the Class 4 roof, you stop that damage from happening in the first place. You avoid that $12,000 payout if you avoid just one claim in 10 years.
The roof has literally paid for itself.
And the premium discount is just the cherry on top.
Wow. That really changes the conversation. It goes from, I have to fix my roof, to, I'm making a strategic investment.
Absolutely. But again, this is where you have to plug your zip code into the Colorado Equity to Premium Analyzer. Grand Junction has low hail risk. The discount might be smaller. Castle Rock, high risk, huge discount. The tool runs John's scenario for your house.
Now, I want to pivot to the regulatory side. Because I'm a cynic. I feel like I could do all this work, install the fancy roof, and the insurance company could still just say, no thanks.
That was the old world. Enter House Bill 251182. This is the game changer for 2026. It completely changes the power dynamic.
Before this, their models were just these black boxes.
Totally opaque. They'd give you a risk score, hike your rate, and say, it's our proprietary algorithm. You couldn't argue.
Now,
Transparency. Effective 2026, they must disclose your property's specific wildfire risk score. But more importantly, they must offer discounts for mitigation, like that roof, or explain exactly why they don't.
so they can't just say, computer says no. They have to show their work.
Exactly. And if they don't have a discount program, they have to state that publicly. It shames them into being competitive.
Right.
But here's the best part. The right to appeal.
So let's say they think my house is a fire trap because of a question near my deck.
Right. So you go out, you remove the bush, you get certified, you submit the proof, and the insurer has to review and update your score within 30 days.
That turns home hardening from a nice to have into a financial necessity with a legally mandated ROI.
You're forcing them to acknowledge the value you've added. It puts the control back in your hands, but you have to prove it.
Okay, let's talk execution.
Yeah.
Because it's not enough just to do the work.
Documentation is everything. For the roof, you need the roofing installation information and certification form. It has to be signed by the contractor. No paper. It didn't happen.
And for the wildfire side.
You want to look at Wildfire Partners. It's a certification program that is gold in Colorado. Specifically, you need to focus on that 0 to 5 foot zone around your house.
What is the 0 to 5 zone?
Imagine a 5-foot ring around your entire house. This is the non-combustible zone. No mulch, no juniper bushes against the siding, no wood piles.
Because that's where the embers land.
That's exactly where they land. If an ember lands on gravel, it goes out. If it lands in mulch next to your siding, your house is gone. Getting that certification is the trigger for those discounts.
So once you run the analyzer, the next step is what we call an insurance policy video review. We can actually look at your current policy and see where you might be leaving those mandated discounts on the table.
It's crucial. You need to verify that your policy actually has the endorsements available to reward you for the work.
So let's summarize this wealth strategy mindset one more time.
Sure. Step 1, leverage your equity with a HELOC. Use the house to pay for the house.
Okay.
Step 2, invest in substantial improvement, the Class 4 roof, the wildfire mitigation. Step 3, deduct the interest under IRS Pub 936.
Lowering your cost of capital.
Step 4, slash your liability, that insurance premium, using the mandated discounts and avoiding those deductibles. And Step 5, you've increased your asset value. A resilient home is worth more.
So what this all means is the days of passive home ownership in Colorado are over. You can't just buy a house and hope for the best.
That's the new reality. You have to actively manage the asset's physical resilience to manage its financial cost.
And with the state launching the FAIR Plan and insurers tightening their grids, here's a final provocative thought for you to chew on. We are moving toward a bifurcated market. On one side, you'll have certified resilient homes, Class 4 roofs, defensible space, low premiums, high resale value. On the other side, you'll have uninsurable homes, stuck on the FAIR Plan, paying crazy rates for barely any coverage. Which list will your property be on in 5 years?
That is the question every Colorado homeowner needs to answer today.
It really is. So do yourself a favor. Use the Colorado Equity to Premium Analyzer. See if the math works for your specific zip code. Don't guess. Check the data. Thanks for diving deep with us today.
Stay resilient.